Right, so premium and discount pricing. What does it mean? How do we use it, etc.? So, premium and discount. Premium simply means selling in a price that is good, and discount means buying in a price that is good, in simple terms. So, a premium means a high price, a discount means a low price. So what that looks like in the market is, let me change my settings right here. Let's do, okay, let's just do that. I think that's good. That'll make it a bit easier for you guys. So a premium is simply an area in a market structure where we are sitting at 50% or above. And a discount price is simply in a market structure where price is below 50% of that move. Let me give you some examples. So in the beginning where we talked about market structure, we can see market was moving down. We broke this low, so we made a low and then we moved up. Let's mark out our highs and our lows. Let's make this simple for you. So we have this low right here. And we have a high right there. There we go. So we have our high and we have our low. Actually, this is a lower low. My bad. Sorry. We have a lower low and we have this low right here. So we have a low, we have a high, and then we broke this low, coming lower than this low. So now we have a lower low. So then we see price move up to create a lower high. There we go. Let's just look at market structure right here, and then we'll get on to premium and discount. We have a low, we have a high. We have price breaking down lower than this low and this low and this low. So that is now a lower low. As price comes up, we can expect price to then push down, creating a lower high up here, typically where we would look to sell, and then expect price to push down. Now the question is, when it comes to using order blocks and fair value gaps, how do you know which area to use them in? So you look at market structure, right? You typically take the fair value gaps that sit in a premium area or a discount area. So in a bearish market structure, you only want to sell in a premium area, which is above 50% of the market structure. We'll mark it out, don't worry. And you only want to buy at a fair value gap that sits below 50% of a bullish market structure. Let's look at this example right here. We have price pushing down, creating this low. So what we want to do now, we mark our high and our low, and then we use a Fibonacci retracement tool, and we mark the high to the low that was created. And we can see that, if I come up here, you can see, let's not extend this to the right, that's just being stupid. Right, there we go. Yeah, cool. Let me just mark that out again for you, it'll just make it easier. So I'm just lining up the lines over here. So from this high over here, I'm just going to do it from this side so you can see the candle better. We mark it down to this low over here, this high from here to this low down here. So we mark it like so. This might be confusing you. Cool. So we have this high over here and this low over here. And if we look, 50% sits around about here. So we would only look for fair value gaps that are above 50% of this move over here. So from this high to this low, anything that sits above 50%, that's what the fair value gap that you want to be using. So you don't want to be using this fair value gap right here, because I know a lot of people do this and it's wrong. I'm just going to say it, it's wrong. You shouldn't do that. I do it sometimes, but that's more for just entries, not really for overall structure, but that's me. Cool. So we have a fair value gap here. It doesn't work out. But we also have a fair value gap up here. So we mark that out. And we see that one works out. Now the question is, we have this high and we have this low, then we have this lower high, then we have this lower low down here. Why did this one not work out and why did this one work out? Well, if you look at the retracement, so from this high to this low, within this market structure right here, we'll call them a leg. That's another word that people use. So this bearish leg over here, so this is like a bullish leg and this is a bearish leg. It's simply just one section of that market structure from one high to the low. So we have this high, we have this low. From this bearish leg over here, if we mark out 50%, which is, as we saw from up here to down here, we'll just move that over there. You can see that this fair value gap sits below 50%, so that is not in a premium area. Like I said before, you only want to sell in a premium and you only want to buy in a discount. The reason for this is, think about it in terms of like an institution or a bank. They want to sell at good prices. They want to buy at cheap prices. If you're not more than 50% of the retracement, why would they sell when price is actually in a discount? Below 50% is a discount, above 50% is a premium. So in this market structure right here, in this bearish leg, price over here, when it was starting to retrace up into this fair value gap, it was below 50%. So price is still technically in a discount within this bearish leg. Why would an institution or a bank want to sell when we're still in a discount? They don't want to sell for cheap. They want to sell when price is high. So as price comes up high, above 50% of this move over here, then we tap into this fair value gap, which is actually above 50% in a premium area. So that's the one you want to use. So what you would do in this scenario right here, we have a market structure moving down. We have a high, we have a low. Well, we have this low over here. So we have this high, then we have this lower low. Then we have this lower high being formed. But you don't know if this is going to be a lower high, but you're anticipating it. So this is where you typically sell, anticipating price to then continue down. So this is where you would sell. And your stop loss, some people also do this, which I don't think is good. They'll just put their stop loss just above the fair value gap, but you shouldn't do that. Fair value gaps are just general areas of price where it was inefficient. So you could either move your stop loss above the candle, so if you look at 1, 2, 3, the second candle that where the fair value gap is, you can put your stop loss above the high of that candle. That is less riskier than just putting it above just where the fair value gap is. You can use the wick high of the second candle to have your stop loss, but to be even safer, you can have it just above the high. So you know this general area, even if price wants to dance around here before dropping, it's got you covered, because if price breaks this high, then we're actually shifting bullish, shifting the structure upwards. We're not actually continuing bearish. So we're not really creating a lower high. We would be breaking this high. So it doesn't make sense anymore to be selling. So at that point, you want to be out of the market. So you would enter at the fair value gap start, and your stop loss will be above the high. This over here you will not use because this fair value gap is below 50%, which is not in a premium. In a sell, you want to sell in a premium price, which is above 50%. So you only look for fair value gaps which are above 50%. You want to mark them out in a market structure. So as price comes up to it, you just place your limit over here, because this is on the lower time frames. This is only the 5-minute time frame. If this was, for example, a 1 hour area, we'll get onto the entry model afterwards, don't worry. We would then drop time frames to like the 1 minute, and then we'll look at market structure. But right now we're not doing that. We're just looking at fair value gaps and premium and discount price action. So we have a high, we have a low. Well, this low is lower than that one, so a lower low. And as price comes up, we look at a fair value gap, which is above 50% in a premium. So we mark that out. And then once price taps into that area, we take our sell with your stop loss above the high. That's the safest thing to do. That's what I do. That's it. That's what I do. And now where would you place your take profit? Again, we'll get onto that. But first easy target that you can always do is just the previous low. Something like this. You get a 1 to 2.5 risk to reward in this setup. Just this scenario right here. Now it's already looking complicated maybe for some of you. Let's just do it again. Very, very simple. We mark out our highs and our lows and our lower lows. So we are breaking structure to the downside. This low is lower than this one. So now we are potentially bearish. And then we mark out our fair value gaps. We could mark out this one, but this is incorrect because from this high to this low, if we mark out our Fibonacci tool, 50% of this is around about here. This fair value gap sits below 50%. It's not in a premium. So you mark out the fair value gap that's higher up in a premium that's above 50%, and you can see that one is the one that worked out and not this one down here. Cool. Now we move on to discount price action. So this is what a premium looks like. Let's move into a discount price action. Right, so we have a bullish example here, and what we can see is we have price. Let's mark out our highs and our lows. We have this high over here. Let's mark that out. This is a high. And this is our low. Just look at this very simple example right here. So we have this high. We have this low. Price pushes up, breaking this high. Also breaking this one. But price pushed up, broke this high, so now we are creating a higher high. So we now have a higher high. Now when we have a higher high, what do we expect next to be created? A higher low, as we spoke about in market structure episode. We have a high, we have a low. We have a higher high, we have a higher low, then we have a higher high, then a higher low. That's what it moves like. So we have a higher high over here. So next we're expecting a higher low to be made, and that's where we want to buy. So let's mark out our fair value gap. We have one here. As we see, we have this gap between these candles. We have one here. We also have one here. We also have one here. We have 3 different fair value gaps. We can already eliminate one very easily. We don't even want to look at it. Reason is because it's not at 50% or below 50%. So when you're buying, you want to buy at discounts, and when you're selling, you want to sell in a premium. So in the previous example that we spoke about, we were trying to sell. So when price is above 50% of that bearish move, you want to be looking to sell in that premium area. Now, when we're buying, we want to buy at discount. So as price is moving up, creating a higher high, we want to buy at the next higher low. And where can we expect that to occur? We can mark out our Fibonacci tool from this high over here to this low. But I'm just going to do it just on this side over here so you can see better. So from this high over here to this low over here, we mark out our Fibonacci tool. Now what we can see is from this high to this low, we can see 50% is at this level right here. This fair value gap is sitting above 50%. Therefore, it is not in a discount. Institutions typically don't want to buy in a premium. They want to buy at a discount. So when price is below 50%, those are the areas where you want to be looking to buy from. So automatically we can eliminate this fair value gap. So as I was saying in the fair value gap video, I'm going to be talking about how to know which fair value gaps are valid and which ones aren't, and which ones you basically want to use. So automatically, just by looking at this and understanding premium and discount pricing, you can see that this fair value gap, just eliminate it. It doesn't exist now. It is a fair value gap, but it's not the one that you want to use to enter. So now we have these two fair value gaps over here. Now, you could simply just buy at the first one, and you can place your stop loss below the low. Simple, right? And then you place your TP, you'll take profit at the next high, or the next highs later on, but that's all liquidity and overall market structure in higher time frames. We'll get onto that. But just for the sake of this episode, you can buy below 50% and place your TP at the next high, and you will always get more than a 1-to-1 or just over a 1-to-1 risk to reward. Always, because it's below 50%. So look for fair value gaps below in a discounted area. So we can see we have this 50% here, we have two fair value gaps. You could just buy from this one, or you could buy from this one. Both are valid because they are below 50%. So both are below 50%, which means they are at a discount. A bullish market structure here, price retraces down into a fair value gap that is below 50% from this high to this low. So we have this low and this high, 50%. Below that is these two fair value gaps, not this fair value gap here, because that's above 50%, that's a premium. You only want to be marking out fair value gaps below in a discounted area. So another way to basically decide which fair value gap to use, if you have two that are below, let's say in discounted areas, is to basically think about it this way. What are fair value gaps and what do they signify? They signify inefficiencies in the market. Now, if there is an inefficiency in the market, price would most likely come back to that area, tap into it, to fill that area and make price efficient. So that is basically what fair value gaps are, and how basically you would decide which fair value gap to use in a discounted area if you're trying to buy. Fair value gaps are areas of inefficiency, and price won't just keep moving in one direction. Most of the time it will come back into areas of fair value gaps or inefficiencies to make price efficient. That is so crucial. So wherever wicks are touching and price is moving up, price is efficiently moving up. It doesn't need to come back to that area to then continue up. It doesn't need to do that. If price is efficiently moving up, all the wicks are touching as it's moving up, fair. It's fair, efficient price action. You don't need to worry about that. It's not an area you'd ever look to buy from. However, wherever wicks aren't touching and you have fair value gaps, those are inefficiencies, and you're in a discounted area. Now you have multiple inefficiencies. Which ones do you use? Most of the time, if the extreme one, which is the last one out of these two, most likely that extreme one will also be tapped into, because that is an inefficiency and that needs to be filled. Price needs to be efficient. Price has to come back to it. Most of the time it will. So you can see in this scenario, we had a fair value gap here, we had a fair value gap here, we had one over here, and it went all the way down to the lowest one, because that was the last bit of inefficiency in this whole structural move. So you would typically want to use the bottom one. Sometimes you might not get tapped into that area. We might just tap into this top one and continue up. If you miss the trade, you miss the trade. However, what is safer is to use the more extremer areas. So if you have two chunky fair value gaps that are next to each other, more than likely it's going to tap the most extreme one. Now, if you had this tiny one down here, it's not really that great to use because it's most likely is going to go right through it and just flip structure overall, because then you're getting too much of a retracement and it's not good. But healthy retracement below 50%, also not too close to completely reversing the whole trade. Looking at those fair value gaps, typically use the more extreme one, because I'm going to repeat this again and again, it's so bloody crucial. Wherever there are fair value gaps, price is inefficient, so therefore price has to come back to that area to fill in that area so that price is efficient, and then we can continue moving. So in this scenario right here, you can see price is moving up. We have this inefficiency here and this inefficiency down here. Price finally filled in these areas. By filled in, I simply mean tapping into the fair value gap. It doesn't have to go all the way through. It's tapped into it. It's collected orders from here. It's filled in that inefficiency. We have tapped into it. And there we go. Now it is now efficient. So now that once price has tapped into all of these fair value gaps, these fair value gaps aren't valid anymore. So now if price was to come down into this area again, I'm not going to use it. Why? Because we've tapped into it and now price is efficient within these levels. Initially when price moved up, these areas were inefficient, but now that price has come back down into these areas and tapped into it and now rejected, that's it. This area over here is now efficient. Price has filled that area, it's filled the inefficiency. That's it. Now, so if price comes back to it, I'm not looking to buy from it anymore. You only want to buy at untapped inefficiencies. Same for when you're selling, same for when you're buying. If it's untapped, that's where you want to be entering. So very, very crucial. That is so important. A lot of people tend to like, look, I'll show you. Let's just basically use this example right here. Let's say these fair value gaps, like the next candle over here, let's say, yeah, let's just say right over here, this candle closed over here, next candle wicked down into both of them, and then finally started continuing up. And then we broke the high. But if later on price came back down to these fair value gaps, some people will still look to buy, and then they wonder why their win rate isn't that high. It's because that area has been tapped into. That price is now efficient. There's no reason for you to really be buying. Can it work? Sure. But we want the most high probability setups. So you only want to look at fair value gaps that haven't been wicked into. The moment a wick goes into it, that's it. I'm not interested in it later on. I'm only interested in it when that wick taps into that area. So when the price finally comes into it, whether it be this much, whether it be all the way down here, that's it. The moment it taps it, actually goes into it, price is efficient now. The inefficiency gets filled the moment price taps into it. So in this scenario right here, price wicks into this one and this one. These fair value gaps have now been filled. It is efficient. That's it. You want to enter at this point when it's initially tapping it to fill in the efficiency. Afterwards, if price comes into it, I'm not interested. I'm not looking at it. I don't care. So, very crucial. So crucial. You need to take notes. Maybe you're already taking notes, but if you're not, take notes. If a fair value gap has been wicked into, price is now efficient. Afterwards, you don't want to look at it. If the inefficiency hasn't been tapped into, and price is now retracing into it, then it is something to look into, to enter. If it hasn't been tapped into, it's open. If it's been tapped into, it's closed. You're not looking at it anymore. So hopefully that will make sense to you. Look, like for example, this area right here, it's inefficient. Let's mark it out. I'm just gonna do it right here. Let's mark it out. That area is inefficient. This area here, there we go. This area here, inefficient. This area here, inefficient, because no candle has tapped into it yet on this time frame. You can see this candle right here, it created a fair value gap. Next one didn't tap into it and continue up. Nothing. All of these are untapped. They are all inefficient, so I'd expect price to tap into these. So that's what I mean. These fair value gaps, after this has happened, these are now efficient because all of the inefficiency has been filled. We have tapped into the fair value gaps. Hope that makes sense. Please take notes of that. It's so crucial. Without it, you're just going to fail. I'm telling you, it's not going to work if you don't understand that key concept right there. I hope I've made it clear enough. It's not as simple as the basics at the beginning, which was just what is a candle, what is market structure. Now it's like we're putting bits together. This is how I go about the market. When I'm analyzing the market, when I'm marking out my charts, I don't just mark out random fair value gaps. I think about these things. I think about the candle highs. I think about the highs and the lows in the market structure. I think about the discounted area, the premium area. I look at fair value gaps. I look at order blocks. And now you can see we're slowly getting into putting it all together bit by bit and how we are formulating some sort of a strategy. There's more to it, trust me. There's so much more. We need to talk about liquidity. We need to talk about higher time frame liquidity, higher time frame highs and lows, internal liquidity. We'll get through all of that, but you can see it's starting to slowly build up. I hope you can see that. I'm trying my best to explain it as best as I can, but this is how my strategy is slowly coming together, and you can somewhat see how I go about looking at the market, and you can see it like working out. So that is premium and discount price action done. So I'll see you in the next one.